If I have a stock that is in a nice rally, Amazon. So I've got Amazon, and they're trading at $622 a share. They've been rallying nicely. They break out, right? And on Friday, I'm like, ooh, I'd like to trade these guys. I mean, Friday is the first day of the breakout. I think that they may move higher. So I go out and I buy next week's option, right? So I buy next week's $6.25 call option, and on Amazon that's probably going to cost me about $6. Okay. I look at this thing and I find out that it has a theta. I'll tell you exactly. Well, not exactly, but right. So this thing's going to have about an 86-cent theta, more or less. Okay, going to have an 86-cent theta. I look at that and I go, well, crap. That means that on Monday, on Saturday, I'm going to lose 86 cents. On Sunday, I'm going to lose 86 cents. I'm going to lose $1.72 of the value of my option over the weekend, no matter what, right? Even if the stock does not move at all. Okay, so if the stock's at 622 on Friday, and on Monday the stock is at 622, my $6 option is going to go down, right, to 428. All right. Well, what if the stock goes down? What's going to happen then? What if the stock price goes from 622 to 620? Well, then it's going to go down even more, and I'm going to lose time value decay plus a little implied volatility collapse because of the movement of the stock price. The thing is, the option that I'm buying is a low delta option, so I'm not going to be as affected by the price movement as I am going to be affected by the time value decay. Guys, anytime you buy an option, anytime you are a buyer of option premium, you are at risk of losing time value. You are theta negative. You are at the market maker's mercy when it comes to time value decay. Yeah, yes. Thank you, Yannick. Yannick says, were you going to get into the S&P? There it is right there, rising 3, continuing to push higher. I'm going to jump in, buy these call options on the SPX, and I'm long 20. It cost me $10.70. Okay, so I had that order stashed away there so that I could very quickly go over and just bam, grab it like a friggin' ninja I was right there. You guys just saw some high-level Bruce Lee ninja stuff going on right there. Back to our class here on the Theta Killer. So thank you for catching that. So we've got a stock that looks like it's moving higher. We want to buy a call option for next week. We buy an out-of-the-money call option. We pay $6 for it. We know it's got 86 cents theta. It means it's going to lose $1.72 over the weekend, and there's nothing we can do about it, right? That sucks. And if the stock goes sideways, guys, here's the thing. We bought the 625 call option. Even if the stock goes up, this is still time value. If it does not go above 625, we accumulate no intrinsic value, and we potentially lose time value over the weekend, which is why Marquet for years has wisely instructed and taught students not to buy next week's options, because you're going to lose. Guys, I mean, it's a $6 option. You're going to lose $1.72 over the weekend. That would just be stupid. Why do that, right? And I would agree. I mean, but I started looking at it and I said, well, what if we went in and we sold to open the out of the money option. So we're going to go way out of the money. Okay, so we're going to sell to open this week. Okay, so you think that answers your question about do we do it in the same week? No, it's two different weeks. We want to sell. Well, there's a couple different ways we can do it. We could do the true Theta Killer, which is to sell to open next week. And you're probably going to go like the 645s call option and sell that for around $1.75. Okay, so to answer your question, yes, we do the same week, but they're next week, right? They're in the same week structure. This is nothing more than a vertical debit spread, which Ray last week in San Antonio said, you know, Bill, I never realized that a debit spread is a directional trade. It is. The debit spread is a directional trade. It's no different than buying a call option, except that you're reducing the cost of the call option by selling a call option. Right? So now, what do I have? I have an option position. Okay, this position right here, this trade is a directional trade. If the stock should move higher, let's just say it goes up here to, I don't know, next week it opens up at $623 a share. Okay, so next week it's at $623. All right, at $623 a share, the open next week, are we in the money on our $625 call option? No. Are we going to lose some time value over the weekend? Yep. Potentially how much? Up to 86 cents on Thursday, and on Saturday, and up to 86 cents on Friday that we're losing time value. Do we care? If over the weekend we lose, right, so right here, weekend loss, let's say that we took the full hit. We took a weekend loss of $1.72. Right? I mean, we did. On this position right here, we lost $1.72, which brings our option price now is $4.78. Okay, is my math right? I'll check my math. Is my math right? We bought an option for $6. We lost $1.72. We're left with $4.78. Are we not? Okay. What was our cost basis on the option? $4.28. That's what I said, Scott. I just said it in a different language. Thank you. What was our original cost basis on this trade? This trade, when we did this trade, because we did it as a debit spread, our cost on this trade was what? What was our cost basis? $4.25. So assuming a full loss of our time value over the weekend, how much are we down on our trade? We're not. Even though we have lost the entire 86 cents of projected theta per day on our original position, by Monday, we are not down at all in our trade. In fact, we're still 3 cents ahead of everybody else who just went in and bought next week's options and suffered the weekend time value decay. She does. Isn't that amazing, Sally? I saw her do that in both the Trader Talk and in the live event, talking about using credit spreads in slow markets. I know somebody's been talking about that for years. Now, I'm not saying, I'm just saying. Y'all know what I'm saying? I might be converting her a little bit. Okay, why credit spread, not a debit spread? I'll talk about that in a minute. Well, actually, I just talked about it. When you see a slow market, Sally, is a directional trade the way to go? Guys, understand, this is a directional trade. Now, I spent $425 net for this trade. Does everybody see that this trade cost me $425? Well, then here's the news for you. If this stock does not go $4.25 above $6.25, I could lose up to $4.25. It's still a directional trade. This is a debit spread. All I did, I took a debit spread and I put a name on it. And I was like, hey, let's call that the Theta Killer, because that's pretty freaking cool that I can buy an option on Friday, and that even if the stock price doesn't move on Monday and the option price drops on Monday, I still am not at a loss because I uniquely use the debit spread to offset the theta risk over the weekend. All I did was take a debit spread, guys. It's a debit spread. It's it. I put a cool name to it. I called it the Theta Killer, but it's just a debit spread. But it's still a directional trade. The stock has to move for me to make money on this. If this stock does not move, I'm not making any money on this trade, and in fact, I could lose up to $4.25. But if I do a credit spread in a slow market, the fact that the stock does not move works in my favor, which is why Marquet has been here recently talking about, you know what, with these markets, if they get slow, maybe you all ought to consider some of these credit spread strategies that John White teaches, that Bill teaches, that you could do in there. And, well, hello. Jose says, so on Monday, do you buy back the 645? Why? Why would I buy back, Jose? To close it out, but why? Okay, so I'm not just asking Jose here because he asked a question, and I know that some of you also have the question, you just won't admit it. Why not close out this trade right here? Or why close it out? So next week comes around, right? And the stock is trading at 623, but it's starting to look a little bit bullish. Why would you close out that leg of the trade? Stock's starting to move up. Okay, Daniel says, if you close it out, you may not cover your theta loss over the weekend. True. Yannick says there's no need to close it out unless it's in the money. In that case, on Friday. Guys, let's go here. Let's say you leave the trade intact. Okay, leave the trade intact, and the stock goes up to, I don't know, $640 a share. Stock goes up to $640 a share on Friday of this week. All right. Jose, if the stock's at 640, how much is the 645 out of the money call option going to be worth on expiration date? Be worth zero, correct. Okay. All right. Which means we're going to make $1.75 profit. Yes? 1 $1.75 profit on that side. Okay, so we made $1.75 profit on this one right here. Okay, that's pretty cool. How much intrinsic value is going to be in the 625 call option if it is trading at 640, if the stock's trading at 640? So we got $15 here, right? And now we paid 6, so this would be worth now 15. Okay, so 15, and that's going to equal what, $11 of, so we would have $11 of profit on this side. Okay, so 11 plus $1.75 means $12.75 of profit. Should be 10, right? 15 minus 6. Oh yeah, I was subtracting the 4. Okay, yeah, you're right. 15 minus 6, so $9 profit. Thank you. All right, so you're making 9, 10.75 profit on that move. Okay, so Jose, to answer your question, would you close out the position? Well, in that case, I don't really see a reason to. Do you? No, me either. Okay. What about, Jose says, well, yeah, if it's under 645, you don't need to. What if the stock is not at 640 like we did here? The stock is at 650. Okay, stock goes up to 650. All right. If the stock is up at 650, now we do need to close out that option. When? Scott says, oh crap, you're going to lose $3.25 on that 645 call option. Yeah, you are. I mean, that's going to suck, right? Because the stock's up here at 650. Exactly. See, at 650, if the stock moves to 650, we're now losing what, 325. So this is going to cost us 325 on this side. But on this side here at 650, this option is now worth 25, right? And 25 minus the 6 that it cost us is going to be 19. So how are we doing here? Yeah, we're still doing pretty good, aren't we? So the answer to the question, Jose, is I do not close out the debit spread leg of the trade until expiration on these. Because the spread, the difference between the two legs of the spread on these Theta Killers is typically so large that if the stock goes in the money, I'm making a ton of money anyway, I'm fine with that. And I've laid off the weekend risk I broke it down by legs there, Al. Okay, so here's the easy way to do this, guys. If you want to figure out how much you potentially could make on this trade, right? You take the difference between the two strike prices, $20, minus the cost of the trade, in this case, what was it? Let's see. Yeah, 425 means 1525 is your maximum profit. 1575 is your maximum profit on this trade. Okay, difference between the strikes minus the cost of the debit spread is going to be your maximum profit on the trade. Okay, so Jose, yes, I will close this leg of the trade out based on the rules that I teach you guys here in the lab, that I teach you guys at the live events that I do, that I'll be teaching the folks in, that I'll be teaching in Atlanta next week with Mark Hay, and it's this, that you always, when it comes to expiration day, okay, on expiration day, we always close all short in the money option positions to avoid any overnight or over the weekend, depending on whether it's a weekly or a monthly option, risk. And that should actually say all short options. So that's first rule. And people say, well, what if it's, out of the money? Well, that's fine. I mean, it's your money. You handle it how you want to handle it. I'm just giving you a set of rules that when I follow it, keeps me out of trouble. When I don't, I get a $660 margin call. True story. Happened to me. And we always close all long in the money options. Okay? So by following these two rules, Jose, yes, I would close, in this example, both positions, because if the stock was anywhere above 625, this is now an in-the-money option. And if the stock is anywhere, anywhere, I need to close out the short position following that rule. So I would close both legs of this trade, but I would not close them until literally minutes before expiration, 30 minutes before, 15 minutes before expiration.